Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Phil Mackintosh, Chief Economist of Nasdaq, Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, as well as Pierre Debbas, founding member and partner at Romer Debbas. We're here to discuss the factors impacting the housing market and what this means for buyers, sellers, and the U.S. economy. It is great to see all of you. Pierre, welcome back to TradeTalks, guys. Welcome back. Let's talk about this here. It has been an interesting couple of years in the housing market, and then there's also been a number of notable structural changes within the space as well. Let's start at the top here. Overall, do you think that there might start to be some improvement as expected rate cuts are on the horizon?
You know, everything about transaction volume is going to be predicated on rates. So when you look at the past 4 or 5 years, we've had housing prices nearly double since the inception of the pandemic, which has been the largest and most rapid price appreciation in U.S. history. Now, during that same time, interest rates have almost doubled, tripled, no, sorry, more than doubled, almost tripled. So now you have a affordability crisis in the country, right? There's no other way of spinning this. With rates coming down, it should help transaction activity significantly. So when you take the country's transaction activity last year in 2023, it was probably at one of the lowest levels in the last 30 years. Whenever you have a drop that significantly, usually whatever the catalyst is for a rebound causes a rather sharp rebound. So I think that with rates, anticipating hopefully this week or next week we see a 50 basis point cut, something of actual substance, another one before the end of the year, go in the trajectory where you get to a regular rate environment. We're not going to see 2.6 again, right? Like, we can't hold our breath for that, but we can live in a realistic time frame of 4.5 to 5.5 interest rate environment, and I think the market will do really well next year. I think you'll see a lot of demand coming, a lot of cash coming off the sidelines. Demand will increase. The biggest problem, which I'm sure we'll talk about, supply.
Right. And so really, we have to square that circle, don't we, Phil? There's just no supply in the market right now.
No one can afford to drop that mortgage that's at 4%. I mean, it's one of the weird things. The Fed put interest rates up so high to stop us all spending, but we'd all locked in our mortgage rates. And so actually the consumer has been able to keep spending, and the monetary policy hasn't had the normal impact. I mean, I think the Fed's got a bit lucky because a lot of the impact of inflation did turn out to be transitory. It was just a lot slower to come out of the system. But today we can see goods is deflationary, energy is deflationary, food prices, like grocery prices, are starting to be deflationary as well. The only thing that's left is the wage part that's pushing services up and the housing costs. And I think no one can afford to buy a house, so they're renting, which is the part of the CPI that's really been sticky.
So there's a couple of things here, Chris. Let's take it to the consumer for a moment. Should we get 25, 50 basis points, perhaps even more this year? What if you have a variable rate mortgage and that comes down, right? Then you're able to spend a little bit more if you get that discretionary income, or perhaps pay off some debt. So it might not be just specific to the housing market either.
So to Phil's point, the rents have gone up for 2 consecutive months, which has put a little bit of scare into the markets. What that did for the Fed fund futures is really ratchet up the number to 90%. There's only going to be a 1/4 basis point next week. However, they're still pricing in 100 basis points for the rest of the year, which means it's going to be a 50 basis point at some point November, December. However, the Fed fund futures have been wrong almost every time over the last year and a half. So we really don't know what's going to happen. We have to see what the data comes into. But to your point, the 30-year mortgage is down to about 6.1% this morning, which is very interesting to me. The yield curve is no longer inverted for at least a day.
Uninverted now. Yeah, but did it mean anything anay, though? It didn't play out as you would expect it to.
You can opine on that a little bit more than I can. But what it means to the consumer, to your point, Jill, is that yes, there will be more money in their pocket, especially on the variable rate. But it depends on when they got the variable rate, right? As you well know, if it's something that they got over the last year or two, it's because they had a house that they wanted to buy because they needed to, whether the family is moving into a first time or if they're expanding somewhere else into the suburbs, moving out of the city. And I'll take that higher rate for a year or two, and then hopefully as things progress, we'll cut down, which means I'll have extra discretionary to put towards goods, services, or whatever else I might need, diapers.
Are there other forces at play here? Let's say, we know private equity has been, buying up a lot of those starter homes, or they are in fact your agent when it comes to renting. Are there other forces at work here besides just rates and limited supply?
Yeah, absolutely. So what happens in the last 5 years when housing demand increased significantly, a lot of that was spurred by Wall Street. So when you go look at, go bid on a house and you'll hear, cash buyers coming in left and right. a lot of those are institutional investors. About 25% of all homes that have been acquired in the last 5 years were cash deals or investor deals. So that's a huge problem, because now, do we want to be living in a society where everybody's renting from Goldman Sachs? And you're talking the top Wall Street banks that are acquiring these single-family homes. So, to be perfectly honest, a policy that as a real estate lawyer, I would love to see some regulation put in place restricting Wall Street's ability to acquire single-family homes. Right. Because it is, for your average American, that is your only and greatest way of accumulating any wealth in your lifetime. If we're going to fast forward 10 years from now and this problem is not addressed today, you're going to be in a situation where your average American has no chance of entering the housing market, and Wall Street's going to be owning millions upon millions of homes. Yeah. And that's going to be catastrophic for our economy, any income disparity or wealth gap in society, and I think it's something that we have to address now. So besides rates and supply, I think that's your biggest problem in the housing market.
The kids will be living with us forever. That's the case. Are our regulators starting to take notice?
They started chatting about it a year ago. A couple things have been proposed, but unfortunately, like anything in politics, it sits there and it's bureaucratic and it'll take years to get through. It's not being focused on enough. Once a year, there's some legislation passed, it's talked about. There needs to be a real strong push to actually make this happen. I think that the window that we have to address this issue before it becomes, irreversible is the next 2 years. If something's not done in the next 2 years, this is going to be a huge problem for society for decades to come.
Yeah, I mean, Phil, do you see that having a larger impact from the macro perspective?
I mean, it's interesting because if you look at wealthy people, they have a lot of their assets in stocks, and stocks have outperformed property. So there's a part of me that's hearing you say that, and I'm like, well, if my rent is lower than the cost of actually buying, and I save the difference and put it in the stock market, and the stock market outperforms housing, you're actually better off. The trick is going to be to get people to actually save the difference. Right. And that's typically...
So it makes you wonder if services spending that we've seen, if that was part of that pie that wasn't going to a down payment on a home or wasn't going into the market.
Consumers have been
it's conjecture, obviously.
Yeah, but consumers have been spending, right? That's the whole basis of how well the economy's been doing for the most part. And where's that extra discretion come? Some of it from wages, and we did finally saw some growth for the first time in a while. But I don't understand, if I may, on the housing part of it, why it would be an issue for homeowners to be renting from the institutions. How would that play out?
In terms of why would it be an issue?
Yeah, why would that be an issue?
One thing that you mentioned is the wealthy put their money in the market. I'm talking about from the perspective of your average American who saves, takes their whole life to save $42,000, which is the median price of a home now, to put them to 10% for the $420,000 home. So in my situation, or my example, they're not taking that $42,000 and putting it in an S&P ETF, where that ETF is going up on average 7 to 10% per annum, compounding and doing much better than real estate, right? They usually generally will buy real estate or put it, if they have the cash, spend it, or at best, put it in a money market account.
Right.
So when you look, how many stories in our lifetime, when you look back when our parents' generation or other people around similar ages, where they acquired a home in the 90s for $200,000 and today sell for $1 million. Now that's how they accumulated wealth, and that's real money. And married couples have a $500,000 exemption on gains tax on primary residence. That's how people accumulate wealth. Now, when your logic is spot on, that's what I'm quite frankly doing right now myself, right? Getting a better return in the marketplace. Why put it in a liquid asset that's not appreciated at the same pace that may be overinflated? Makes perfect sense, but logic's not going to apply to your average American.
Housing is for saving,
right?
Because once you're in the house, you've got to keep it up to date. You've got to pay for the repairs. And you got to pay the mortgage.
Yeah, no, it's a sponge in many ways.
And you got to pay the mortgage, but eventually you own it, and if it appreciates, you're levered.
Whereas if you're renting from private equity, you're just not building your own personal equity. Right.
That makes sense to me.
So there's also been structural changes within the real estate space as well. Tell us about that, and does it impact the housing market or buyers or sellers?
In terms of the NAR settlement?
Yes.
So earlier this year, there was a huge lawsuit that came about against the National Association of Realtors, which is one of the largest trade organizations in the country. Now, the premise of the suit is that the brokerage community, through trade organizations such as NAR, were colluding together to maintain commissions artificially high, and that they weren't letting the consumer know that commissions were in fact negotiable, which they've always been negotiable, may not have been as widespread of information. They won this lawsuit, or I should say the lawsuit settled for several hundreds of millions of dollars. Didn't necessarily win it, but they had a very compelling argument in court. So what that's doing today is that an agreement coming about in the market, which has never been really factored into our marketplace, buyers brokers agreements. So historically, if I were to hire Jill as my broker, and I would say, hey, you know, let's go tour homes, we would never sign anything formally. You know, I can give you a call, I can call my next door neighbor, Mary, as a broker, I can keep going on and work with 5 different people, and I can choose last minute who I want to end up working with. Now, today, once a buyer's agent starts having substantive conversations with a buyer, and to the point where they take them to start touring homes, that's a threshold to tour a home, you have to have this agreement signed in place. And what the agreement states is that if a seller is not willing to pay you a broker's commission for representing the buyer, that is on the hook for paying you that commission. Where in past, that was never a case, it was a free service. The seller always paid both brokers' commissions. So that's where they essentially decoupling commissions, where it's the point of it is to make it more negotiable, right? And theoretically, to increase affordability in the housing market, which it won't, to be perfectly honest. It's not going to move the needle $1 in the housing market, because at the end of the day, if the buyer has to pay the 3% and the seller saves at 3%, the buyer's just going to reduce how much they're willing to offer in the house. Or the seller's going to pay both and it's going to be business as usual. Luckily, in most major markets, you know, like our practice, our residential practice as lawyers, is focused on Manhattan and the Hamptons. In 2 challenging markets and 2 of the most complicated housing markets in the country, and also 2 of the most affluent housing markets in the country, I don't think much will change. In the rest of the country, where, again, using your median home price of about $420,000, that 3% is a significant amount of savings, where sellers will say, you know what, I can go put this on Zillow, I can put it on some website, and I'll do the tours, and because there's such a low, you know, amount of supply in my neighborhood, I'll just, you know, stick to my price and see what happens. Buyers, again, going back to my example of your average American, and this is the most important financial investment they ever make in their lives, buyers are going to go in unrepresented because they can't afford the 3%, right? They can't afford the $12,000 to pay somebody a commission when they can barely put down the $42,000 to buy the home. So buyers are going to go in unrepresented, making the largest financial investment in their lives, which is my concern of this. So now, how does this lawsuit help the consumer in any regard? That I don't agree. That I don't see. I don't see how it helps the consumer. It was a free service, and it was a free service that actually had a lot more value than I think the media and the public gave the brokerage industry credit for. Could it have been revamped where transparency was more transparent in terms of commissions being negotiable, different commission structures? Sure. There's a number of things that they could have done better. Admittedly, like they're not completely, you know, flawless. But I don't think that this specific suit is going to help the housing market much at all.
It almost sounds akin to justifying a financial advisor and having that level of expertise for someone representing you, whether you're a buyer or a seller. And I'm glad you laid that out for us, because it doesn't change the calculus at the end of the day, right?
No, not
it's not like it's going to add more supply to the market, or it's going to make it more attractive for the buyer or the seller at any point.
The theory is that if a seller only has to pay 3% instead of 6%, and a buyer goes in unrepresented, and the seller saves that 3%, that potentially that the buyer can use that as negotiation leverage to reduce the price. But again, it's a very theoretical argument, because when you're, you know, depending on demand levels where they are, we're several millions of homes short in terms of current demand levels. So at the end of the day, the seller's not going to say, okay, I'm saving 3%, let me give you, the buyer, some of that benefit. They're going to get the price. They're going to get the price because of the supply issue. And the seller's just going to keep more money. That's what's going to happen. They're just going to net more money. That's the bottom line of this whole thing.
Right. And I guess, Phil, at the end of the day, the question is 25 basis points, 50 basis points, if that's what we get in 2024, is that really significantly going to move the needle anywhere? I mean, you know, for people who weren't able to save, even if it was something liquid like money markets, where you're getting 4.5%, 5% in some cases. And if you're looking to pay down credit card debt, if you're on the other end of the spectrum, is that 25, 50 basis points going to make a difference? Well, I guess it's a central question.
We're talking about 100 basis points by the end of the year.
Right.
That's
Do you think that's feasible? 100?
It's what's being priced in.
It's what's being priced in.
If it's not by the end of the year,
Right.
it should be by January or February anyway. So that's a whole percent. I think, to your point, that's going to make money market funds a lot less relatively attractive. They're still going to be returning more than the inflation, so they're having a real interest rate, which we haven't seen much of for the last 2 decades. But it's going to change the calculus of what do I do with my money. I don't just put it in the money market fund and earn good returns. Maybe I start thinking about stocks again. Maybe I start looking at properties. And for the people that are in those mortgages, the average mortgage rate that people are fixed on is about 4% right now. So if we come from 5.5 down to 4.5, mortgages are obviously a little bit higher. They're sort of 6-ish now. If we get that down to 5, it's like maybe the calculus of switching to a bigger house that's what you need in a city where you can get a better job is worth it, because it's not a 300 basis point difference, it's just 150 or 100 basis point difference. So I think as we get closer to sort of a 3.5%, 4% interest rate, you'll see more and more freeing up of the supply of houses. But at the moment, people see the delta of selling their house and joining a new mortgage at a completely more expensive cost is just not palatable.
I mean, 3.5 to 4.5, 5%. I mean, from a historical perspective, that's an attractive rate. I mean, we're not going to see those sub 3%. I mean, I hope not. That means we have some troubles. Yeah.
Yeah, and you hope you don't see the Fed funds going much below 3, because that means we're having a recession.
Exactly.
That's a bigger problem.
So perhaps we just have to have a reset in our minds. And this is the environment from a historical perspective. It's normal, if not better.
We're almost there.
Right.
I think we need 150, 200 basis points
I think
before
totally
we're
agree.
normal.
Right. This time next year.
As we get closer to that, people will start to make the cost-benefit analysis on housing.
But
and start to sell their secondary houses.
But from the housing perspective, even if you're getting 5.5 to 6.5%, historically that's a good rate.
Sure,
You're not paying double digits.
It is, but that's when your average home price is maybe $275,000.
Right.
Today at $420-something plus $1,000, it's expensive. Right. It's a lot of money.
Affordability is worse now than it was before the credit
even with the
crisis.
higher interest rates because of
the high interest rates and the price rise.
Absolutely.
It's worse than before the credit crisis.
Yeah. So imagine if we're still stuck with limited supply, right? It's not going to change. Even if rates go lower, doesn't necessarily mean that housing prices will go lower because of the lack of supply.
That's right.
But at least they'll be more affordable because your mortgage rates
Right.
Right.
Exactly. Well, right now, 70% of the mortgages in this country are sub 4%, with majority of those 30-year fixed. So how do you open up that supply and that inventory without having a seller, like you were alluding to, saying, okay, well, I can now make a trade at somewhat of an increase in monthly carrying costs, but not triple? Like besides life events, what's sparking you to actually part with that mortgage and part with that property and create inventory? Nothing. The problem is we have to incentivize developers to develop housing, and not just develop luxury housing, but to develop housing starter homes. And the issue that we have now is that there's no tax incentives being proposed by either political candidate or presidential candidate that gives developers an incentive to develop starter homes as opposed to more lucrative investments or larger ticket items. What I think needs to happen is that there has to be tax incentive for these developers, and on top of it, it has to be limitations that they can only sell to those who will be a primary occupant, an end user, not second home buyers, not investors. We don't feel bad for them, right? We feel bad for the end user, the primary occupant who can't afford. There's the barrier entry is too high. And what you can do is a lawyer on deeds, properties are conveyed through deeds, you can have deed restrictions where you can say, okay, this developer received a tax incentive to creating a $350,000 home, which is the median price of a home in this area. They sold it to an end user who is going to be using this as their primary residence. They can only sell it to another primary occupant for the next 10 years. And after 10 years, you're free to do with the house what you want. But at least that way you guarantee 1 to 2 owners that are primary occupants, and you create more stock for who really needs stock, which is your average American who's going to be living in a home. And you secure that with a deed restriction for a decade or maybe even longer. We've had this in the city where wherever the city's given dilapidated properties that they owned to developers, they'll say, we'll sell you this at $1, but you have to now live here, or someone has to live in one of these units as a primary residence for the next 25 years. I've seen that before. And what happens is it gives you the incentive to rehab, develop a property, and to serve society in a proper manner. So that's what I think should be done. It's something that's never been done, but it's something that, when we talk about, yesterday we had the presidential debate, and Kamala Harris is talking about giving $25,000 credits to homebuyers. That helps, sure, it certainly does. But at the end of the day, first of all, I think we should stop printing money and handing it out.
Right.
That's number one. Number two, it's not really going to fully solve the problem because it's only helping the problem slightly. What will help the problem is providing stock to primary occupants and restricting any other use of the property.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.